Does a SSAS reduce capital gains tax? Firstly, let's get into what is capital gains tax. Capital gains tax, quite often reduced to CGT, is the tax that you pay on the profits that you make on the sale of an asset. If the business buys an asset such as a commercial property and that increases in value and is subsequently sold, then the gain over the original purchase price, potentially less than any costs, is subject to capital gains tax. So you can pay capital gains tax on a number of items. So the question is, does SSAS help with capital gains tax? Just as a very quick recap on SSAS, stands for Small Self-Administered Scheme and has to be set up by an actively trading limited company. So let's do this. Here we have the limited company, and we'll use this as a husband and wife limited company. They are both directors. The limited company is the sponsoring employer and sets up a SSAS. They are both members, the husband and the wife. Obviously, the limited company is allowed to make contributions to the SSAS for the members, and that contribution will help to reduce the corporation tax that is due by the company, because it's a tax-deductible expense, providing it meets the wholly and exclusively for the purpose of the business rules. Now, let's assume that this limited company owns a commercial property that is on the balance sheet of the company. If that property remains on the balance sheet of the company and increases in value from the date that they purchased it, then that gain on sale will be potentially liable to capital gains tax inside the company, therefore more tax to pay. So does it make sense to move that asset off the balance sheet, being a commercial property, into the SSAS? Absolutely. Let's have a look at the numbers. So if we assume that this property is worth £300,000, for the purposes of this, I will say that there is no debt on it. So if the company were to make contributions for the directors, and potentially the company could put in £150,000, let's say, for each director as a corporate contribution, which would obviously give a very nice, healthy capital gains tax deduction for the company. So the money has gone in out of the company straight into the pension scheme and got a corporation tax deduction. So on a £300,000 contribution to pension, and assuming the company pays corporation tax at the 25% rate, that will give them a £75,000 reduction in their potential corporation tax bill. Very attractive. But as you can see, what we're going to do is we're going to give the company the money back in a minute. So the limited company owns the property. The SSAS is going to buy the property off the company. So it goes through the sales process. We'd have it independently valued by an independent chartered surveyor, and a lawyer will obviously convey the property to the SSAS. The SSAS is the owner. So the property moves from the company off the balance sheet, and if it has gone up in value, there could be a disposal for capital gains tax purposes in the company. So that is one thing you need to check with your accountant. But obviously, if you've had a nice big deduction for corporation tax, that may help quite considerably. So we're going to buy the property off the limited company. The £300,000 property ends up inside the SSAS. And obviously the funds, the £300,000, because we've had to buy it off the company, the £300,000 flows back to the limited company, so they are back in the cash. So effectively, you've put £300,000 into the SSAS, only to get it back a few weeks later when you actually sell the property. So it has effectively become a a free transaction, in fact, better than that, because not only have you put the money in and got the money back, you've managed to save £75,000 of tax along the way. So how does capital gains tax work in this particular example? Well, once the property is in the SSAS, then the SSAS is statutorily exempt from CGT. It does not apply. So you've put the property in, let's say at the same value, at 300. Okay, if that property rises in value to say £400,000 or £500,000 in the years to come, and the SSAS subsequently sells that property, the funds will obviously come back to the SSAS, but there is no capital gains tax on the increased value over the original purchase price. So that has to be great. So not only have you saved corporation tax on the way through, but you've also eliminated any future capital gains tax as well. It's a win-win all round. But we would love to hear from you. If your business assets are potentially liable to capital gains tax, what are your plans and what are you going to do about it? Please comment below.
Book a call with us via the link in the description below. If on a mobile device, simply hit the More button under the video title and pick a convenient time to speak. Feel free to share this video with others that may benefit on WhatsApp or in other online groups or channels. Like, subscribe and hit the notification bell for lots more SSAS related content, and leave a comment if you found this video helpful. For more, visit onecrownpensions.com.